Okay, we are going to be moving into investing. Getting a general overview. We're not going to go too deep, but we're going to talk about the concepts and how it differs from savings. So, savings we've talked about. It's a vehicle to accumulate money for the future, but a savings account is for short term funding needs. It's really what we want to build is an emergency fund. Now, the advantages of a savings account, it's FDIC insured up to $250,000. It's a demand deposit, so you can access it a certain number of times per month, usually with relative ease. You can link it to your checking account, so there's a lot of advantages to it. Unfortunately, we earn a very low level of interest right now. So we're not going to earn any income off of our assets at this point. Now, another form of savings could be in a certificate of deposit. Now, we limit our access to the money for a certain amount of time. It's a time deposit account. We earn slightly more interest, but not a whole lot right now. Money market accounts earn a higher rate of interest than savings accounts, but usually they have a minimum balance and a minimum to get started and a minimum balance to maintain. But we get a higher rate of savings off of that. Unfortunately, it's only higher relative to the savings accounts since all interest rates are extremely low. Now, savings account should act as your emergency fund. Now, your emergency fund, or how much we should have in our savings account, should be equal to 3 to 6 months of expenses. And that's our rainy day. So we blow out a tire. We have that there. We have to go to the emergency room. We have our money in our emergency fund, and we don't have to put things on our credit card. Okay. Now, if we've taken the time and methodically built up that emergency fund, and we have 6 months of expenses saved up in that emergency fund, it's now anything that's in excess of that amount that we need to consider investing. We can't just have earn that low level of interest off of those funds. So we need our money to work a little bit harder for us. Now, some of the accounts you're going to be opening, we're going to want to set these up. We're investing for the future. So we're investing to one day retire. So the accounts that are going to be you're going to have access to for retirement are either a traditional IRA, a Roth IRA, which you need to set up on your own, or a 401k, which you can be set up through your employer. Now, all of these, or excuse me, two of them operate similarly. With the traditional and the 401k, these are pre-tax dollars. Okay, so any dollar that I put in there is not taxed from that year's income. So if I decided, just as a round number, I was going to put $1,000 into my traditional IRA. If I made $50,000 a year and I put $1,000 into my traditional IRA, then I would only be taxed as if I made $49,000. So it gives me a little bit of a tax break for doing the right thing. Traditional IRAs, at least in 2019, the limit was $6,000 per year. That's the same for Roth IRAs. Roth IRA is something different where it's a post-tax dollars. So I've already paid taxes. So if I put $1,000 in and I made $50,000 a year, they still tax me as if I made $50,000. But the money that I put into this account grows tax-free. And when I retire, I won't pay any taxes on it because I already paid it in my working years. With traditional and 401k, since I avoided taxes during my working years, when I withdraw, I'm going to have to pay taxes on them. Okay, so these are retirement accounts. And if we funded them, well, now the excess from there has to go into a brokerage account. Okay, and this is a taxable account, so there's no tax benefits to opening this account, but we don't want the excess capital just to sit in a savings account earning next to no interest. So if we've funded our IRAs or our 401ks, and we have excess left over, it's time to think brokerage. Okay, we're not going to go into too much that you can invest in that. Not today. I don't want to overwhelm you because the categories can get pretty deep. Now, one other account that you guys should be wary of is a 529. 529 is there's no tax benefit for putting into it, but your funds grow tax free so long as any proceeds are used to fund educational expenses. Okay. Now, the standard investable assets that we would be able to invest in a brokerage account. Now, in 401ks, IRAs, 529s, we're going to get into mutual funds and or exchange traded funds in later videos. We're going to only open today with the two major ones that you can invest in. And this is what everyone talks about, common stocks. So when we get our headline numbers from the Dow Jones or the S&P 500 or the NASDAQ 100, those are common stocks. Okay. Now, some of those stocks that trade every single day may or may not pay a dividend. Some stocks return profits to their shareholders in the form of dividends, while others view themselves as growth companies where they take the profits and reinvest it back into the business. But what they see is the price of their stock tends to go higher, quicker, where the stocks that pay dividends, they go up and they go down, but they don't move as violently because they're paying a dividend stream, an income stream. Okay. So if it's not paying a dividend, you're hoping the only way you're making money is if the price of the stock goes up. Now, preferred stocks are a different form of shares. They're still equity or ownership of a company, but people that own these prefer to have the dividend stream, and they're not really concerned with capital appreciation. There's also a pecking order, who gets paid first in the event of bankruptcy or liquidation. So that would be kind of very important in this environment right now. But if outside of recessions, it all you got to pick your poison, or what type, how much of your investable assets should be in income producing things, and how much should be in capital appreciation. And that's different for everyone. It's all dependent on your risk profile. But once again, preferred stocks don't move around in price as much. They move similarly to bonds. But people invest in those because they want the dividend income stream as opposed to capital appreciation. Okay, I'm going to stop with equities today. Next time we meet, we're going to talk bonds and into mutual funds. Now, there's a lot of options available here. So we're going to take our time and we'll learn about that in the next video. Okay, have a good day, guys.